Good afternoon. Welcome to the TMA Detroit webinar. Thank you all for joining us today. Today's program is Beyond PPP to Planning, Process, and Profitability, Part 2. Before we get started, I want to thank all of our sponsors. First, our gold sponsors. First, our gold sponsors, and then our silver sponsors, and then our bronze sponsors. We could not have gotten here without you. Thank you for your support. If you're interested in becoming a sponsor, please reach out to any TMA Detroit member. We'd love to have you join us. Now let's get started with today's program. You may recall that on March 27, 2020, the U.S. government passed a bill under the CARES Act, creating the Paycheck Protection Program, fondly known as PPP. Last June, TMA Detroit presented a program which provided some insights on what to do after PPP, how best to advise clients, and what challenges PPP recipients might face. Today's panel looks back 1 year later, exactly last June, at the 2020 PPP program and reviews how the first PPP program worked and how companies might approach future rounds of PPP. The panel will also highlight specific experiences, both that worked well and ones that presented more of a challenge. So to set the stage for today's program, this panel will run about 45 minutes, then we will take questions for the remaining 15 minutes. Please send your questions in as the program moves along. Now on to today's program. On the call, joining me as panelists today are Darren Burmania from the law firm of Bodman, Merrill from the investment banking and advisory firm of Heritage Capital Group, Scott Keusch from the alternative lending bank of Crestmark Bank, and then Kreamer, my colleague from Newpoint Advisors Corporation. Now, rather than introducing them myself, I will have each of them give a brief statement of their firms and their backgrounds. So Nan, I'll start it off with you.
All right. Hello, everyone. So I am with Newpoint Advisors. To give you an overview of who we are a financial advisory firm. We operate in the U.S., primarily throughout the U.S. and Canada. We offer a full range of services to small businesses, small and medium-sized businesses, and we focus our efforts primarily around cash flow and operations best practices. Our focus is in the small to medium size, so in the 1 to 50 million revenue range. I've been with Newpoint for over 2 years. My background is in finance, mostly in the corporate finance world.
Perfect, thank you. Mary, what about you?
Hi, Mary Merrill with Heritage Capital Group. We're an investment banking firm headquartered in Jacksonville, Florida, with offices in Savannah and a presence really kind of throughout the East Coast, Midwest, and to some extent throughout the South. We do sell side and buy side, and we also do financing raises for middle market and lower middle market companies. We deal a lot with privately held companies, and we're dealing a lot with family-owned businesses or individual proprietor-owned businesses.
Perfect, thank you. Darren?
Good afternoon, I'm Darren Burmania. I'm with Bodman PLC. Bodman has 5 offices in the state of Michigan. I'm in our Grand Rapids office. I'm a member of both our banking and business practice groups, and also a member of our COVID-19 response team, primarily tasked with assisting both business and banking clients find their way through the PPP program, amongst other lending programs over the past 14 or 15 months. And hopefully we can add some information to our dialogue today.
Thank you, Darren. And last but not least, Scott.
Good afternoon, everybody. Scott Keusch. I am with Crestmark, which is a division of MetaBank. We do quite a few things. For Crestmark specifically, we have a national footprint. We do all different kinds of asset-based lending, working capital lines of credit, inventory financing. We also do small and large leasing options. And we have a government guaranteed lending division that does several SBA products, most notably why we're here, which is PPP as well. Been doing that for about 12 months now. My background is in commercial finance. Started locally here at a firm called Greenfield Commercial Credit. Was there for about 9 years, went to Bank of America, did cash flow lending there for about 7 years. And now I am at Crestmark as the portfolio manager for the commercial capital division.
Wonderful. Thank you, Scott. I have the privilege of serving as your moderator. Like Nan, I work for the financial advisory and turnaround consulting firm of Newpoint Advisors. We've been in business for 8 years now, focus on companies in the $1 to $50 million revenue range. Our average client's about 10 million in revenue, and we look at businesses with 10 million in senior debt or less and average about 2.5 million. One of our unique characteristics about our offering and the solutions we provide is that we often work on a fixed fee, fixed timeline basis, and not an hourly approach in order to make ourselves more affordable to the small business entrepreneur. So with that, let's go on to our program. Before we dive in, I'd like to share some statistics with you on both rounds of the PPP funding. So I'll turn to those. We'll have them on the screen, I'm sure, momentarily. Let's give it a second. All right, there they are. So you can see both rounds, and we'll talk primarily about round one. We might touch on round two, but you can see in round one, look at the loans approved, the total. I'm not going to go through all the numbers, but you can see that the average loan size for round one was 102,000, and round two, you can see the 41,000 below it, quite a bit smaller. Total average about $70,000. Interestingly, if you go to the top right, you can see that 67% of all loans were under 50,000. But then as you go higher, 98% of all loans were under $1 million. And as the graphic on the top middle right shows, for loans over $1 million, average loan size was 1.5 million. But if your loan was less than $1 million, they were pretty small, average about $19,000. So you can see the big disparity between large companies and small companies, although the vast majority in volume went to, in unit volume went to the smaller companies, but the preponderance of dollars, certainly a lot of it went to the larger companies. So that's just a little data point for you, a little snapshot. We can take that down. We'll go on to the program, and we'll start right from the beginning. First off, for our audience members that may not have familiarity with PPP, I'd like to call on Nan to go back in time and give us a 20,000-foot view of PPP round one and its key terms.
All right. So just probably a refresher for a lot of people, but basically the PPP loan program was a $953 billion business loan program signed into law March of 2020. It's an SBA-backed loan that was designed to help businesses with less than or 500 or less employees to keep their employees employed during the COVID-19 crisis. So it also facilitates a forgiveness option, provided the businesses use the funds based on what their approved use is. The initial deadline for application was June of 2020. It was later extended, and it finally closed May 31 of 2021. So the amount of the loan was up to 2.5 times monthly payroll costs, maturing 2 or 5 years with a 1% interest rate, no collateral, no personal guarantees, no lender fees. And the use of funds were primarily for payroll, but could also be used for rent, utilities, and then COVID-related incremental costs used by a company that had to reconfigure their workspace. So that's it in a nutshell.
Wonderful. Scott, anything that you'd like to add?
She did a pretty good job summarizing all of it. The only thing I'd probably add, since she ran up through the round two date, is that in round two, they increased the formula for average payroll specific to NAICS code businesses that started with 72, which were essentially hospitality businesses. And the multiplier was 3.5 times for those particular businesses.
Okay, that's good to note. Darren, I'm gonna see if you've got some nuggets that you want to add to this.
Yeah, I guess my thought, Paul, is looking back on round one, a lot of what I think about when I'm especially now working with clients that are bringing issues to us as they begin the forgiveness process is just what a chaotic time it was in April of 2020. And as this program was rolling out and all the issues that the economy was dealing with, employers were dealing with, individual employees were dealing with, it was just a really trying, stressful time. The government was trying to roll this out as quickly as possible. Lenders, borrowers, everybody had a limited amount of information. And what we see, I think, on the back end is that is probably the creation of some of the problems we're dealing with now from our perspective when we're working with clients. But the goal was to pump as much money into the economy as possible to keep employees on the payroll, and I think the PPP program did that. I think we'll get to that as the program goes on.
Wonderful. Okay, now with that background, let's move on. I'm going to ask Scott, who I think would agree that he sat in the trenches, deep in the trenches for large part of the last 15 months. So you spent a lot of time administering the PPP programs for the bank's borrowers. So you're quite familiar with the process. What are the things that you would say that PPP did help address?
I would say that the main thing it helped address was I think the intended design of the program, right, which was keeping people on the payroll. We definitely saw that across the board with all of our clients. Employee retention was a big thing. We actually did an analysis of our particular loans that we did, and just within the loans that Crestmark had issued, we estimated that we helped maintain about 18,000 jobs across 37 states. So clearly, and that was in, for us, a relatively small number, right, of the total loans outstanding. And so definitely helped in terms of what it was intended to do, which was that idea of driving, payroll and driving job retention. So.
Yeah, it's fantastic that it was really, you guys were able to save that many jobs. That's one of our things that actually, I'll say at Newpoint, we measure ourselves on recovery of senior debt and jobs. You see in our tagline. And so to be able to retain and keep that number of jobs is fantastic. Mary, what about you? What things do you see that PPP did help address?
So, I mean, the companies that we saw that were most successful using their PPP loans were those that really were able to pivot and move their business into an uncertain future. We had companies that, really did a quick technology pivot, and they were able to keep their employees on board because of the PPP loans. They were able to give, a little bit of latitude to some of their customers on payment terms. They were able to really kind of keep their businesses going, even in cases where, they saw significant decreases in revenue. By the end of the year, they were able to take advantage of that opportunity to shift into a faster future forward.
It's fantastic that was able to happen. Darren, gonna see what your thoughts are on this.
Yeah, I echo what Scott and Mary said. I think the one thing that, from my perspective, what I'm seeing on the back end is when things have gone wrong, right? So while Mary's absolutely right, where for the most part, the program was very effective in keeping employees on the payroll, we're now also seeing the impact of some of the decisions that were being made very quickly in April and May of last year when companies didn't have the full information available to them. So one example I would give is we have two separate clients, independently managed, completely different executive groups, totally different industries. They both were suffering. They're in industries deeply impacted by the shutdown. Both deemed themselves eligible for the PPP loan and did not think or realize or even consider the issue of common ownership going into obtaining their PPP loan. So they didn't even think about it because their executive teams were completely unrelated. But someone raised the issue on the back end early this year, said, as they're filling out their forgiveness questionnaire, said, you know what, we may have an affiliation issue. So we have two fairly decent sized employers, one with 200 plus employees, the other one with 400 plus employees, with substantial PPP loans that used the funds to keep their employees on the payroll as the program was designed. And now, through no fault of their own, other than hurrying through the process, have ended up with unforgivable loans on the books that they need to address on the back end. So while the program did work extremely well for a lot of companies, there were limited circumstances where perhaps it didn't work as well, even when the companies were trying to do the right thing.
Understand that. Yep. So I'm going to turn this conversation to a different aspect here, and I'm going to call on Mary. Mary's our resident expert on investment banking. How has PPP affected the M&A process in terms of pricing, due diligence, timing of transactions, issues that buyers and sellers may face?
So I'll actually start with buyers, since Darren just raised that topic, the topic of the affiliated entities. So we did see situations where we were selling a company and the buyer had issues because of the PPP loan outstanding in the company they were acquiring. In fact, in one case, they had to restructure, the selling company had to restructure the business to accommodate getting around some of the rules that would have otherwise caused for the portfolio company of the buyer to have to be lumped in with them under the PPP regs. And in that case, they ended up spending as much in legal fees as the amount of the loan. And then they still, in most cases, when we sold a company that still had an outstanding loan, even before the October updates came through, we were seeing escrows to cover any unforgiven balances. So in the full amount of the loan, interest, et cetera. So that trend started well before the guidance came through. And so I think on the sell side, what we did see is a lot of companies that already knew they were going to sell just didn't take the loans. Even some that were impacted, pretty significantly, were still able to sell if they were in a business that was able to, grow and shrink without as much pain as some of the businesses like hospitality. So I'd say it affected what they could take off the table at closing. Prices overall, for companies that were still getting sold, valuations did not really go down. What happened is those that had any kind of question mark just got waylaid or, set aside for the future to try to sell later.
So in those cases where money was escrowed, are you seeing situations where the escrows are broken and they go back to repay the loans and interest? Have you seen any cases that have panned out like that or not?
Only once the loan is forgiven.
Right. And if the loan's not forgiven, the escrowed money.
And that's what the escrow is there for. So.
Right.
Yeah, I think that it for companies that have had an impact in PPP, I think we are seeing a little bit more overall. Not in PPP and COVID. I'm seeing a little bit more overall willingness to have maybe a little bit of holdback or seller financing, and I think a little more demand, especially from the institutional buyers for that, but certainly not across the board.
If a buyer is approaching a company and they have a broad, mandate in certain industries, and I'm looking at two different companies, would I be more interested in a company without PPP because of the challenges, I guess, or the time frame it takes, or as a buyer, am I sort of agnostic on that?
Well, all other things being equal, I would say certainly it'd be easier to deal with the company that didn't have a PPP loan. But I will say it's still a seller's market. And so, there aren't, what we saw, and my point about prices didn't go down, is those companies that still were saleable, they actually went for more money, not less, in many instances, especially those that didn't have a big impact from COVID. So I would say, yes, if all other things were equal, certainly don't want to deal with it. But, for a company that's got, some hurdles to jump through, but is worth it in the end, I don't know that I would say it was heavily impacted.
So there's no multiple effect at all on purchase price?
Honestly, not in my opinion.
Okay, that's interesting.
I think what's happened is a lot more companies had to pause their plan for selling.
Right, of course. Darren, what about you? What are your thoughts on this?
Yeah, I agree with Mary on almost everything. What we saw was for the for initial 6-month period, there was certainly a slowdown in the M&A activity. People were trying to find their way, see what the economy was going to do. And then as transactions started to close, people were sort of figuring out their best practices of how to handle an outstanding PPP loan. And that happened until the October 2nd procedural guidance came out. That ultimately ended up being very helpful. While the guidance is it's really relatively limited in terms of it's only a few pages long. It really built the framework that buyers and sellers knew that they could work with when dealing with a PPP loan. So that really helped as we got towards year end and closing deals. And the only issue we ran into repeatedly was a PPP loan is not on your standard closing checklist as you're thinking through an M&A transaction. So it's not your typical debt that you would simply pay off at closing. You have to do things in advance. And so that's what we ran into, is getting the lender's approval, escrowing funds, whatever you need to do in advance of the closing. That was just one additional item that people oftentimes forgot about until they got near the finish line, and then we had to deal with it.
Did you see any closings that were delayed because of waiting for the forgiveness, or they just worked through with the escrows only?
Yeah, we saw some minor delays, nothing. Thinking back to year end of 2020, we had a very busy M&A cycle. And I think we had a number of transactions that were hoping to close earlier in December. And then if something came up with a PPP, it would occasionally cause a few days delay, maybe a week delay, but nothing dramatic. And I don't think I saw a single transaction severely impacted by the presence of a PPP loan.
Okay, that's interesting. Okay. All right, so we're going to transition and pivot from M&A kind of back to the PPP piece. I'm going to turn to Scott and start exploring here. What happens after companies receive these funds? What can borrowers expect from the SBA?
Yeah, so I mean, on the forgiveness side, once the loan was issued, it got relatively quiet for a period of time. As I think everyone is aware, we mentioned in the beginning, most loans had a 16-month deferment. So there was a bit of a calm after the storm until the forgiveness process started. So really, being that the lenders administered this program for the SBA, they were really quiet even after the loans were issued, and really didn't come to the forefront again until forgiveness started. And so if you want, we can go a little bit into that process of what that looks like in the forgiveness. So
Sure.
Yeah, so for forgiveness, the program changed a little bit, obviously, since inception, but it generally landed in the relatively the same area, which was that when you went to apply for forgiveness, you had to demonstrate that from the perspective of the loan proceeds, you used at least 60% of the proceeds on payroll and no more than 40% on eligible non-payroll expenses. And so the process is probably fairly easy for most people. Probably varies a little bit by institution. Crestmark, for example, works with a third party that helps facilitate the forgiveness process. But generally speaking, the process would be that the borrower would fill out a forgiveness application, the one that would be most appropriate for them. There's a few different ones based on loan size. And in most cases, they need to provide some form of backup. Under 150,000, they actually don't need to provide that anymore. It ends up being functioning like your tax return. You just retain the backup in case the SBA comes calling for an audit. So you would provide the application, you provide the backup. It goes to the lender takes a look at it. They have up to 60 days, they review. Once they're okay with it, then the application itself, not the backup, will get transmitted to the SBA for the SBA's decision process. Most of the time, in our experience, at least what we saw, within 60 days of the application being submitted to the SBA, we would see the decision. And in our experience, we've had a pretty high rate of forgiveness. Most people have been getting approved for the forgiveness that they've requested. The audit process is a little bit different. So, the audit process is automatic for loans over 2 million. It can also be random for loans under 2 million. And while it starts the same in terms of providing the application ultimately to the SBA. What happens in the audit process is then the SBA will reach back to the lender through the portal, and they will start to ask for a list of items that they want to review as part of that process. The first thing obviously would be all of the backup that was provided at the time of application for forgiveness, which is usually retained either by a servicer or the lender. And there's usually some back and forth, and that process definitely takes longer. I would say on average, our experience has been about 90 to 120 days right now on audit level deals. So.
Do you have to go down to the employee level for those large companies where you have, hundreds of employees? I mean, can you show them a gross payroll number, or do you have to sort of itemize to some extent so they know you're not, kind of commingling things?
I'd love to say that there's some consistency, but some of it depends on the reviewer you get on the SBA's end. And so I've seen a wide swath. I've seen some backup just as simple as what you're referring to, which is 941s, showing the quarterly wages and a couple other documents, and that seems to suffice. But I have certainly seen reviews where they drill down into the corporate tax returns and they want to see the payroll reports. And I've seen lots of various requests from the SBA. So I would say if you're looking for the average is that most of the time it's a more high level review. It's just the audit deals obviously get a little more scrutiny to them.
Interesting. Can you comment on, this is sort of a anecdotal observation that I've had at least with my clients and locally here where I'm in Detroit. It seems like when it came to forgiveness, the smaller local regional banks, which I think are more nimble, were able to, turn it around quicker, make their links available for borrowers to click on and do put all their documentation and upload it than the larger banks. Certainly, it seemed in the initial administration, in March and April last year, that was the case. And then for a forgiveness perspective, again, it seems like some of the larger banks just had trouble moving as fast as their smaller regional local competitors. Have you seen that at all?
Yeah, and I think that's probably an issue of scale. A lot of the smaller, the regionals, ourselves included, we use a fairly well-known servicer in the SBA industry, and they administered a lot of that for us, and it made it much easier and much more streamlined. But obviously, there's a fee for that service, right? And so I suspect that some of the larger national banks, they built out their own platforms, probably because the fees started to become cost prohibitive for them. Obviously, as we indicated in the beginning of the presentation, that these are not lucrative loans that we were making. And so that's probably a big part of it is because they were building out their own platforms. They were kind of building the road as they drove on it, so to speak.
Do you have any notable war story, not to put you on the spot, but of an interesting account where there may have been not exactly the correct use of funds, or there's some foggy gray area? Did you see anything like that? I'm sure you did. Is there any good nuggets you can share with us that would be maybe a little bit not only entertaining, but something that people should watch out for, like, paying your payroll taxes, those kinds of things?
Oh, geez. How much time we got left? So
you got 1 minute.
Yeah. So we actually have been very fortunate so far in the loans that we've made, that we have not, knock on wood here, we have not seen anything nefarious, which has been great for us. Definitely from a war story perspective, a lot of it is, thankfully, probably for most borrowers, is really, it's more between the lenders and the SBA and just some of the hoops that we have to jump through, some of the strange things they ask for, that we need to kind of go back and forth to get these things over the finish line sometimes. And so that's definitely been part of it. That sometimes the forgiveness applications go in and they just kind of get stuck for a while, and you have to go back and kind of knock on the SBA's door and say, what's going on? This came in a few months ago. And so more of it, it's just that stuff. I mean, there's definitely stories, but those would take a while. But thankfully, nothing nefarious, nothing bad, which has been a blessing for us so far.
Okay, good to hear. Darren, What's your take on this?
Yeah, I would agree with Scott that at the beginning we were dealing with eligibility issues. That was of the utmost importance at the very beginning, and then you have this lull for an extended period of time until we got to the dealing with M&A transactions towards year end. And then seemingly at the beginning of this year, we really started getting a lot of issues arise relating to the forgiveness application. And that was triggering what we found a lot of companies to sort of look back at April and May of last year and diagnose their own problems. So the application itself is incredibly simple. So even sophisticated companies that would otherwise reach out to us for help, they're looking at this loan application and saying, we can complete this by ourselves. We don't need to talk to Bodman or anybody else. And unfortunately, that led to issues with affiliation, eligibility, and other things that now, a year removed from the chaos, they're recognizing that they may have issues. And that's primarily what we've seen, what I would call mostly honest mistakes. You asked for war stories, and
yes, please. I know you have a few, so let's hear some of the good ones.
One in particular that did involve some nefarious conduct was we had a client that the CEO and CFO effectively conspired to inflate the numbers of their PPP loan, and then redirected a sizable portion of their loan into their own personal bank accounts, and then effectively funded payroll with the remainder, which none of that is a good idea, of course. So once this was found out after the fact, obviously, it raised all sorts of issues. And as the company began to look into it and dig into it further, it raised affiliation issues, all sorts of other things. So now you've got a borrower that is a good, solid company that did need the funds to maintain their payroll, but suddenly they have a multi-million-dollar loan on the books that they have to repay over a very short period of time with their lender. And they've been very transparent with their lender about what's going on, but none of it's good news. So that is one of the examples of the abuses that took place. But I would say on balance, everything else not everything, the vast majority of what I've seen has been, if there are mistakes that were made, they were honest mistakes. But most of the loans that we've worked on have sailed through, have received forgiveness, or we still anticipate forgiveness. So the program in that regard has been very effective.
So what is the fate, or what will be the fate of the two, I guess, gentlemen that decided to siphon funds into personal accounts? Where do they stand? Are they, first of all, I guess, are they still part of the company, which I hope not? And second of all, what's the prognosis, and how do you is the money going to get clawed back? What's the story there?
Yeah, that's no longer with the company, either of the individuals that were involved. But that's still subject to investigation. So there's, unfortunately for our client, it led to a number of other law firms being engaged to handle segregated portions of what we're dealing with. It was a mess from all angles, but our client's doing the best they can to deal with it retroactively. Unfortunately, sometimes bad actors have the controls of the organization, and things like this will happen.
Yeah, I think we've all been through situations like this, and hopefully you'll learn once, but sometimes you have people that are very good at covering things up, make it look like it's normal, and you get taken. So in the time we have left, about 10 minutes roughly, the two areas that I'd like to cover is, what worked and what didn't work. So we'll start off with what worked, and I'll start off with a very quick anecdote. This is an example of a client where something worked, although I would put the worked in quotes. It's a subcontractor. It's in the steel business. Came into the PPP, the COVID period, with about $2 million in unpaid payroll taxes. As I mentioned earlier, it's never a good thing. So they had that, and certainly their bank wasn't happy. In fact, their bank wanted them to leave, and they are actually exiting their bank. And during the 2 rounds of the PPP funding, they were able to procure about $6.5 million. So big funding. It's about a $40 million revenue company. If you fast forward from that, today where they sit is they have no tax liabilities on their balance sheet, and they certainly have a ton of extra money that they use for payroll, although they were doing okay. They do a lot of infrastructure work, and everyone knows that there's some infrastructure legislation that's currently on the floor. So they're doing well, but they ended up being able to pay off their $2 million tax liability and have some rainy day money in their pocket. And it worked on the one hand, but the other thing that didn't work, I don't think, you'd like to think people learn from their past sins, and instead of paying, vendors, instead of paying payroll taxes, you pay vendors. But in this case, since it was so quickly absolved off the balance sheet, I don't think it sent the message to management of what not to do. They just skated by. So it's kind of worked and didn't work. So with that aside, Nan, I'm going to call on you to talk about what was successful and what it did to help everybody.
Yeah, I had, we were involved in a client that every week it was a challenge. Okay, we have this much cash, what are we going to pay? Their payables were pretty significant. They were in the close to the 2 million or more range. They applied for the loan, they got the loan, and they were still in business, so they were still earning income. And in this case, it was good news because they were able to use their revenue that they were generating, and they paid off a lot of their outstanding debt or payables really. And they were able to use the funds according to their approved use for payroll purposes. The big thing that they did at the same time is immediately they changed their cost structure so that they weren't going to run into the same situation coming once the PPP loans were exhausted. And that was really the biggest good thing that they did. They changed their cost structure. They changed the way they were doing their own business. And we're no longer working with them. They went off, and they seem to be doing their lenders are happy with them again. So
Okay.
So that was a good news story.
Awesome. Good to hear. Scott, what about you?
What worked? Probably I think one of the things that worked best is, people probably heard a lot of stories about a lot of lenders who were targeting their existing client base only. Crestmark took a little bit different approach, and actually quite a few of the loans that we issued, about half, actually went to non-clients. And as you mentioned, somebody was kind of administering it in the trenches of the program for about the last year or so. I had a lot of conversations across the country, really, with just really small mom and pop businesses, people who did not have lines of credit at lenders when this all went down. And if not for the program, they probably would not have made it. And so had a lot of great conversations with businesses like that. And that was, to me, I mean, we worked some pretty crazy hours. I think everybody on the phone here during that time probably worked some pretty crazy hours. But I think that's what kept a lot of us going, was dealing with those businesses, knowing that the funds were going to those people and that they were truly making a difference. And so I would say, for me, by far, that's what worked best
Okay.
with the program.
All right. Mary, what about you? What did you see that worked well?
So I had a kind of similar story to one of Darren's, actually, and that's a case where the company was able to use that money to pivot more quickly into a more rapid technology onboarding that had been part of their strategy already, and they were in process, but a much slower process over several years. And they had actually immediately made cuts as soon as the economy started shutting down. This actually enabled them to bring employees back and reposition them into areas where they could help the company pivot faster for the rest of the year and into the future. And they did. That company was in the educational technology and publishing space, and they were able to more quickly get into areas that they weren't heavily in, like into services for the home. So homeschooling, parents and kids at home, and they've been primarily selling to schools directly. So they I wouldn't say that it, they replaced all the lost revenue with that, but what they were able to do was take advantage of the time to use those employees to help them shift. And then they, at the end of the time, they ended up kind of relieving the employees that were more old school and, keeping the employees that, and this wasn't by and large, always the case, but the employees that weren't going to be helping them in the future were still furloughed in the end, but they had longer employment and a chance to get a new job, later on somewhere else if they didn't get repurposed already in the business. The company is doing phenomenally well. It definitely hurt their top line, but by the end of the year, they were able to really bring it around and get back on track on the bottom line.
Interesting. That's an interesting story. Darren, what about you? What did you see that worked well?
Yeah, it's interesting because, the nature of what I do, most of what I see is things that didn't or are not working well. So when people are calling me now, it's not because they're celebrating a success necessarily, it's because they have a problem and they need to fix the problem. So I've seen a lot of the things that did not work well on a very limited basis. I think what worked well was on a macro level, the program, right? So I remember doing a presentation at, I think it was on March 29th, as they were ready to sign the CARES Act into law. And one of the things we were emphasizing is we know very little, but this program is designed to help employers snap back. It's helping employees stay on the payroll through these crazy times, but it's also going to help the employers in the economy hopefully snap back and get people back to work, businesses ramp up quickly. And I think for the most part, it did that. Obviously, there have been some companies that didn't make it through. A lot of them probably wouldn't have made it through anyway. But those that were relatively healthy, I think the program really did work well.
Fantastic. So I'm going to pivot and stay with you because you started off with talking about things that did not work. So since you're the guy people go to with problems, things don't work, what are some of those don't work things?
Yeah, I mean, there's a lot of them. A lot of it relates to eligibility and affiliation rules that were undefined at the time we went into the program. So you've got all these borrowers desperate for money in April, May of last year. We had limited guidance from the SBA. They knew that, and yet we still couldn't get that information. So you've got borrowers requesting billions and trillions of dollars, not knowing what the rules are to the game. And that is a lot of what we've seen on the backside. Now, we can blame the SBA for that, but the reality is, I think they did, on balance, the best they could under the circumstances. Unfortunately, there are some casualties along the way. I've got clients, of course, that I've given some examples that were good faith borrowers that thought they were doing the right thing for their company and for their employees. And it turns out, because of the application of some pretty broad affiliation rules, they're not eligible. That's problematic. They've got to figure out what to do now. So I think that's what didn't work so well.
Okay. All right. Back on M&A. I'd like to hear from Mary. I'm sure you've got a good story. What is something that did not work well, where there was a pitfall or a rabbit hole?
Yeah, honestly, it was the affiliated entities issue. That's really what sunk some deals and created problems in selling companies, both on the buy side, and sometimes it was a company, that was for sale that had an issue they didn't realize they were going to have because, these, as Darren said, these rules finally became clearer as they were moving forward and didn't come down the way they were hoping. So. Really, it was the affiliated entity ruling.
Sound like that's a sticky area. So, okay, interesting. Scott, what's your take on what didn't go well?
A couple things. What did not go well for Crestmark is the success of the program actually kind of caught us a little bit off guard, and because it was so successful and people used the funds as intended, our interest-bearing loan balances ran off for a period of time. So that wasn't anticipated, but that snapped back. I would say the other thing that did not work well would kind of be the other side of the coin that I think both Nan and Mary had mentioned, which is, certainly given some of the segment that we deal with in terms of businesses, people had a prime opportunity to use those funds to cover their operating expenses and make the necessary changes during that time. And they didn't, right? So they kind of kicked the can down the road for a few months, and then the money dried up, and then we're right back into the same situation where, you know, the availability that was there kind of dries up, and then they're kind of, you know, kind of the rat on the wheel again. So.
Yeah, we've seen a lot of can kicking. Nan can attest to it. A lot of you know, things were considered a bad Band-Aid for those folks, and getting a lot of grace from other stakeholders for now at least. But Nan, let me turn over to you here. What did not go well from what you saw with your clients?
Well, again, it was the can kicking that Scott mentioned, but basically, yeah, I have a client. In fact, I'm still working with them because they're still struggling. They received the funds. They did reduce a little bit of their cost structure, but they quickly decided, okay, I'm kind of fat and happy now. I've got the PPP funds, and they're back to struggling. But I'll tell you what really happened even more so, that maybe they, you know, to their defense, they didn't really understand, but their supply chain is really a big issue. They can only get the inventory they need to meet about a third of their sales objectives. They keep thinking it's going to come in, so they're not letting any people go, but they're really hand in mouth right now to make ends meet, and it's frustrating for everybody involved. But that's what didn't go well, because again, they did not address their cost structure or perhaps really anticipate their supply chain being an issue, which kind of goes back to the fact that, you know, my advice was always right from the beginning: talk to everybody that you deal with and find out what they're doing, so that they might have gotten tipped off that their supply chain was going to be an issue and that customers still wanted the goods, and where are we going to get it? So it's taken them a while to try to get more suppliers online, but you know, their whole supply chain in this particular industry, it's a garment industry, and they're just struggling getting the goods.
Yeah, the supply chain pretty much everywhere is very, very stretched. I do have a few clients too that really, you know, suffered from that. In fact, they kept employees on because they were afraid to lose those employees to competitors, given the tightening labor market, which has only tightened further. And so they were paying those employees, and there were oftentimes they were standing around not doing work, but the cost of losing that employee, having to find somebody if you could, and then training them and losing them to competitors was very high. So we saw a lot of that, which, you know, that didn't really incent the right behaviors, but that is what happened. So anyway, we've got about 6 or 7 minutes left. We're reached the end of our formal program, our presentation. I'd like to hand it over to Amanda and the audience at large to have a chance to ask any questions to the panelists. Any questions, Amanda?
None that I have received.
Is it a bashful crowd? No one. We answered all your questions. We were so good at that. I doubt that. But if no one has any questions, we'll continue on. And what we'll actually do, and if you do have a question, please submit it through the chat. Is we'll touch base on the second round here. And again, I'm going to turn it to our resident in the trench expert, Scott Keusch, to give us a little overview. I believe my understanding is that round is closed, but is there anything you can talk to on the round? Maybe, maybe things that improved, I hope, and got better.
Well, I mean, I would like to say that was the case. It actually popped into my head as we were talking about the kind of the horror stories and, the war stories. And the one thing I can't believe I forgot to mention, which is really a product of round two. I don't know if everyone's aware, but what happened in round two that was different is when you made an application to the SBA, they did some due diligence traps on their end before they issued the authorization, which was different in the first round. In the first round, the lender would pretty much enter the information into E-Tran, which is the SBA's system, and it would immediately kick out the authorization or the loan number. in round two, they actually did some different due diligence searches, and that actually caused approximately 250,000 hold flags at the SBA. And the and the lenders then had to work through those flags, which was probably the most painful part. So I'm surprised I forgot about that. Administratively, that was probably the hard part. The program itself, in terms of what the borrower needed to do, and the formulas and such, that was relatively unchanged from round one. So really, the biggest difference would be if there was a hold that flagged for some reason, then the research involved in that, and then the borrower potentially having to provide some documentation to clear that stuff. So.
Okay. I'm not going to put anybody on the spot, but anybody else on the panel want to speak to round two? Did anything change from your either client perspective or what you saw in the market?
I had a client that actually worked with the lender to support the 25% difference quarter to quarter, because they had an interesting twist on their revenue, and the lender was able to work with them to say, well, I think you can probably look at it a certain way. So the lender did get very involved, and I was a little surprised, but they managed to work it out, and they did get the loan. So it's interesting that, you know, you were saying the SBA was asking a little bit more questions, but in this case, the lender got very involved with the underlying information and was able to really help the client fill out the application properly.
Okay. So we have gotten a few questions here. Let me read one of them. Okay. Given that this template program has proven to be an effective way to get support to businesses, do you see any other scenarios or reasons that it could be kept around or used for other circumstances, i.e. when certain areas are declared disaster areas? Does anybody have any thoughts on non-COVID disaster uses for this type of funding? Scott, maybe you have a thought.
Yeah, I mean, I think that's definitely an idea. Probably like anything, the balance then is, where do you strike the balance between the speed and efficiency, which really is what you want in a disaster type of scenario, right? Like with COVID or natural disasters, how do you balance that responsibly with the I don't want to use the word underwriting, but in a sense, the underwriting of that process, right? And so how do you structure it in a way that you are efficient and you deliver it timely, yet there's not any more stories of Ferraris hitting the news, right? So, but I think that's a great question. I think there's definitely, I could see scenarios by which that would make sense. The question is, the devil's in the details a little bit, right? How do you make that work?
Yeah. Anybody else on the panel have any wisdom on other uses for PPP, non-COVID uses that would make sense?
I think, Paul, it could be effective in the event of another substantial recession like 2008. Those of us that we all lived through it, obviously, but looking back on that, and one of the things I remember from sort of the after the fact look back on that was the program needs to be big and it needs to be audacious, and you need to get money in people's bank accounts as quickly as possible. And as Scott alluded to, you kind of have to let the underwriting let it go a little bit and not pay attention to perfection necessarily, even though as taxpayers, we all want the money to go to the right places. When you're trying to prop up a failing economy, speed is what is needed, not perfection. So.
That's very well said. It's great. So we've really gotten to the end of our hour here. It's 5 o'clock up straight. I'd like to thank Amanda from O'Keefe and Associates for all of her help making this happen and her work behind the scenes. And also would like to thank the panelists. And on behalf of all the panelists, we thank you very much for your time. We certainly hope that you'll be able to take something away from today's program. Wish you a great day. I do believe for those that are staying on the line, I think there is some networking that is outside of my purview. So I will hand the microphone back to Amanda. And again, thank you everybody for your participation today and appreciate you coming out.